Okay, amazing. Hi, everyone. Thank you for joining us in today's seminar. The topic today will be the state of US consumers, and we'll be looking at it from three different angles. The first one will be the macro picture and the K-shaped economy. The second one will be the impact of tariffs and price volatility. And the last will be consumer sentiment and real data of consumer spending across different income groups. Today, we have the pleasure of being joined by Leo Feller, Chief Economist and Numerator. Leo, I'll let you introduce yourself.
Yep. Thank you, Ben. Pleasure to be here. So Leo Feller, Chief Economist at Numerator. I'm also a visiting economist at the Chicago Fed. And previously I was at UCLA as a professor there and at Johns Hopkins prior to that as a professor there.
Yeah, and we're also joined by Jack Conley, Global Economist at Kraft Heinz. Jack, I'll let you introduce yourself as well.
Morning, everybody. Pleasure to be with you this morning. My name is Jack Conley. I'm the global economist at Kraft Heinz. Before Kraft Heinz, I was at Compass Lexicon, an economic consulting firm, and I'm looking forward to talking to you today.
And I'm Benjamin. I'm a product specialist at Macrobond, so a platform expert, and I'll be guiding the discussion today and connecting the dots as we go. Before we get into the topic, I'd just like to give a brief introduction of Macrobond for those who may not be familiar with us. So Macrobond is an all-in-one integrated platform for global firms who transform macroeconomic and financial data into insights. And I think we're best described in our four pillars. The first one being access. So we provide over 300 million time series. We have also the ability to ingest your own proprietary data and third-party data sets in one environment. The second one is modeling. We provide a no coding analytical tool. And we also provide connectors and APIs to Excel, Python, R, and other analytic platforms. Third one is visualization. You can create charts that are automatically in your company branding and share those charts dynamically. They will dynamically update as new releases come out. And our last pillar is publish. So you can share your insights and charts across teams, departments, and clients as well, with everyone having access to the same data in real time. That being said, Leo, I'll let you get us started with the macro picture and what you've been seeing across different income groups in US consumers.
Ben, thank you so much. So let me first start off by saying thank you for this opportunity. I use Macrobond uh, basically every single hour of every single day that I'm at work. And I'll show you how I use it to make charts using both public data and Numerator's proprietary data. So before we really jump in, let me talk about Numerator's proprietary data. So Numerator has this app called Receipt Hog, where we pay consumers, we compensate consumers to take pictures of their receipts. And so you can see all the way here on the left, right, a consumer taking a picture of their receipt. They can also link their loyalty accounts, such as their Amazon account, their CVS account, their Walmart accounts. We take all of that and bring in that data so that we get a picture of what a representative sample of 200,000 households in the US are buying on a daily basis. It's a gamified app. And then importantly, we can push out surveys to consumers asking them questions such as, how likely are you to buy Dove again? Or asking them questions like, what do you think inflation will be a year from now? So we collect data from consumers and we can add that up to get a sense of what's happening in the US economy. Now, the US government goes out and collects data from retailers on how much they're selling. And this is how they put together something called the retail sales, the monthly retail sales report. So just to give you a sense of how closely numerator data is going to match with government data, you can see here in every one of these categories, right, what's happening to total retail and food services sales, excluding auto and parts, which we don't track, sales from dealerships. But you can see how closely the numerator data in light green and the US Census data in dark green track each other. You can see this specifically by type of retailers. So general merchandise stores is going to be places like Walmart and Costco. Food and beverage stores are going to be grocery stores. You can see how closely numerator data is tracking with government data. This is going to be the data that we're going to be looking at when we're looking at how do low, middle, and high income consumers, how are they shopping? And what does that suggest for the future of the US economy? Now, one more just housekeeping note right here. Every time you see Macrobond labeled in some of these slides, That's because I was making the charts using Macrobond, right? Using the Macrobond software. All right, so let me start off with some inflation scenarios. We just got our Fed Reserve meeting yesterday. You heard from the Fed Reserve meeting that there were two hard dissents, right? Two Fed Reserve presidents who dissented, but there were also four soft dissents, which were Fed Reserve presidents basically who weren't on the voting committee this time around, saying they also think that they should have held rate constant because they are worried about the potential for inflation. So what you see here is core PCE. This is the measure of inflation that the Fed Reserve uses, that the Fed Reserve mostly relies on. And you can see that we had our inflation peak in 2021 and 2022. Inflation then came down. More recently, inflation has started to, be a little bit sticky and it has ticked up throughout much of 2025. Coming into 2025, I had three scenarios. One was a scenario where we didn't have tariffs, where we had, if anything, very limited targeted tariffs that were phased in slowly. We had some components of tax cut extensions, but we had a fiscal tightening, and that would have gotten inflation back down slowly towards the 2% target. I had a high case scenario, which was inflation, would be much higher if the Fed Reserve lost independence, if we had across the board tariffs plus retaliation from other countries, plus large scale deportations. We've gotten many of the things that are in this high case scenario, right? We got tariffs, perhaps not across the board, more limited than initially suggested during the Liberation Day announcement. We have not gotten retaliation from other countries. We're starting to get deportations, and I'll go into that in more detail later on. And then we got, higher fiscal deficits, extension of the Tax Cuts and Job Acts. What we haven't gotten yet is this loss of Fed Reserve independence, right? It might happen depending on what happens with Supreme Court decisions, what happens with Fed Governor Lisa Cook, with who the next Fed chair is going to be. But so far, it looks like we're in this mid-case scenario where inflation is going to continue ticking up as tariff effects pass through later into next year, and then inflation is going to come back down. But mostly in this scenario, we really don't have inflation getting up to beyond 3.5% year over year, right? But continuing to tick up from now going forward. Why haven't we seen much higher inflation yet? So when I speak to a lot of Numerator's clients, which are large consumer packaged goods companies and large retailers, they will say things like, look, we are locked into contracts with retailers, right? We can't just take price whenever we want to. We can only take prices at certain period of the year. Those periods for large CPG companies tend to be in January, or they tend to be in June, July. And so initially, a lot of CPG companies were basically saying, I'm going to wait to see what tariffs are going to be before I actually pass this on to retailers. Now, also, CPG companies, not only do they have contracts with retailers, they have contracts with their suppliers, or they are hedged, right? So if you are a large CPG that manufactures soup or manufactures beverages and you buy a lot of aluminum, you were most likely hedged or you had contracts with your aluminum suppliers to make sure that the effects of higher aluminum tariffs weren't hitting you initially. But those contracts renew, they just take a while to renew. Then we hear a lot that CPGs have one bite at the apple when it comes to negotiating with retailers, right? They can't just show up at Walmart and pass on higher prices. They are only going to do that once they have more information on where tariffs are going to land. Now, we are in this phase that CPGs are starting to pass on higher prices. And one of the CPGs that I spoke to, a large beverage company, basically said, look, we're going to take a 6% price increase right now in January, right? This is our opportunity to pass on higher aluminum tariffs to retailers. 6%, as you know, is not the 2% inflation that the Fed is targeting. It tends to be higher than normal. And so we do expect inflation to start picking up during these next 6 months as CPGs and then retailers are finally able to pass on tariff costs to consumers. Now, the consumer's under more stress right now. That's going to limit their acceptance of higher tariffs. That's the one thing that's very different this time around than in 2021, 2022, when we had the last burst of inflation. And that's because at that point in time, the consumer was just more flush with cash given the pandemic era savings that they were able to accumulate. We have to keep in mind that it takes a while for shocks to pass through the economy. So back in 2021, 2022, we had mass vaccinations. Consumers were able to go out and spend. We saw this big increase in consumer spending. We only saw an increase and a peaking of inflation about 14 to 16 months later. It takes a while for any kind of shock, such as an increase in consumer spending, to translate into higher inflation. We got a tariff shock, starting back in April. That tariff shock got paused, right? We have lots of pauses implemented. We are now at around a 16, 17% effective tariff rate. And so it'll take a while for that tariff cost to actually show up to consumers. If you think 14 to 16 months out, that gets us into mid to late 2026 for tariff inflation to finally peak. In terms of economic growth, we've actually had a pretty resilient year so far in this mid-case scenario. It could be the case that the Fed Reserve loses independence, that this leads to some chaos in the bond markets, in money markets, and that causes a potential for a recession in 2026. But most likely we are going to be in this case where growth is okay. Economic growth is okay. We expect a little bit of a hit right now because of the government shutdown. That should be a drag to economic growth. But overall, growth is okay. Inflation a little bit higher than it should be. The big concern for the Fed Reserve that we heard yesterday is this balance of we are getting economic growth, but we're not getting the job creation that tends to come along with it. And that's because we are tending to get higher productivity. And so we're able to grow without the economy is able to grow without the corresponding growth in jobs. If you look at job growth, the official job numbers, they suggest that job growth has actually not been all that great during the past several months. And you see this slowdown if you look at the 12-month 6 month right here, and then the 3-month moving average, they all suggest that labor market growth has been slowing. And this is why the Fed has been cutting rates, is that they are aware that there is weakness in one side of its dual mandate, which is slower labor market growth. Now, most of the jobs that we've been adding, right, we've added a total of 684,000 jobs year to date. If you look at where most of those jobs have been, they have been in healthcare, right, and social assistance, 565,000 jobs. They've also been in places like state and local government hiring, and then in leisure and hospitality. Where we've actually been losing jobs is in manufacturing of things like durable goods, or if you just look at non-durable goods, right, which is going to be where most of CPGs are going to sit, food manufacturers are going to sit. Then you're going to have, a little bit of job loss in these sectors. But it's definitely not been the case that, the tariffs that we've implemented have so far led to a resurgence in U.S. manufacturing, because U.S. manufacturing has continued to lose jobs. The next, sector would be federal government. As we know, we've had lots of federal government layoffs. And then professional and business services have lost the greatest number of jobs. So we are adding jobs. They just tend to be in sectors like healthcare and social assistance, whereas manufacturing and federal government jobs and professional and business services have still been struggling. The unemployment rate has been ticking up very slowly to 4.4%. Now, I also put the underemployment rate, which includes people working part-time for economic reasons, right? Because they can't find a full-time job. And here again, you see that this has ticked up very slowly. So it's not just that people aren't able to find a full-time job, they've shifted to working part-time. Both of these have gone up pretty steadily. Historically, 4.4 isn't that high. It's not that different than we were in 2018. And same as this 8.0 underemployment number, historically not that different than where we were in 2018. So the labor market is okay. It's just been moving in the wrong direction. When we look at job openings per worker, we are at one job opening for every one unemployed worker, right? The heat that generated so much inflation in 2022 is basically gone in the labor market, right? One job opening for every one unemployed worker, again, historically not that bad. It's where we were in 2017 and 2018. It's just that we are moving in the wrong direction. And if this were to continue, it would be worrisome. And this is why the Fed rate cuts that we've gotten have been dubbed risk management cuts, right? We are seeing layoffs ticking up, but again, still below where we were in 2018, 2019. And we are seeing fewer quits. Now, people only quit their jobs if they feel like they're going to be able to find another job more easily. Quits have come down again to the levels that we were at right around 2016, 2017, much further down from where we were when we had a lot of heat in the labor market. When we ask consumers in the Numerator data, and we do this every month, we run a survey of about 2,000 representative US households, and we ask them, if you or someone in your household were to lose a job they wanted to keep, how easy or difficult do you think it would be to find another job that paid about the same or better? And what I want you to see is that more and more people are saying, look, it would be very difficult or somewhat difficult. We see both of these having ticked up more recently, right? So our consumers, our panelists are saying, look, if I lost my job, this is a more difficult labor market. It would be more difficult for me to find another job that paid the same or better. Now, normally, as people get more nervous about the labor market, that should lead to a pullback in consumer spending, right? People get a little bit more nervous, they hold back a little bit on consumer spending. We're seeing that somewhat, but not entirely when we look at Numerator data for what's going on in retail sales. So let me first start off with government data, because government data is going to say, look, we had this big jump in retail spending. This is in nominal terms. Let's inflation adjust to get it in real terms. And this essentially gets us quantities, not just prices. And you can basically see that retail sales still jumped in terms of quantities, but then has kind of held steady, increasing much more slowly in this period than we were increasing in this period. So if you're a CPG and you're saying, look, yeah, we're growing, but we're growing a lot more slowly than we used to, the reality is that there was this big jump and we're getting back to trend. We're still above trend in how much it is that people tend to be buying. Now, Numerator data, I showed you previously that we match pretty well with US government data. We can break apart who is doing the retail sales by low, middle, and high income consumers. And so what I want you to look at here is that low income consumers, those earning between 0 and 60,000 per year, tend to consume roughly around $2,000 per month of these everyday items that we track of sales at Walmart and Kroger's and CVS's and Costco's. If you look at high income consumers, you saw a surge in their spending, and then you saw it actually remain pretty constant, and it's gone up more recently. There's a little bit of a dip here in October, right? But high income consumers didn't really pull back. If you look at low income consumers, they definitely pulled back from their highs, right? And they are in real terms not consuming as much as they were in May of 2021 when the economy reopened and everyone was flush with pandemic cash, right? You still see this gap. Although more recently, you've seen lower income consumers starting to increase a little bit more their quantities, how much they're consuming. I will rebase this, and you can basically see that if we put everyone on the same starting point, index 2019 equals to 100, you see the K-shaped economy. You see higher income consumers basically, increasing their spend in real terms. You see the cutback amongst low-income consumers, and you then see a little bit of recovery since 2024 in terms of how much they're spending, but you see this bifurcation of the consumer. Now, one thing here is that we are using the same inflation measure, the same government inflation measure for all consumers. And that's because the government doesn't collect a different inflation measure for low and high income consumers. There's just one inflation measure. Well, at Numerator, we can see what it is that low-income consumers are buying, and we can construct an inflation index just for low-income consumers, and we can do the same for high-income consumers. And so an additional factor that has been complicating this is that low-income consumers are the ones that experienced the highest inflation since 2018 compared to higher income consumers. So for all the things that Numerator tracks, which is going to be groceries and apparel and electronics and toys and home goods and tools and home improvement, for all of those things, the prices for low-income consumers are up around 33.6% since January 2018 versus 29.8% for higher income consumers. And this includes the ability for consumers to trade down to lower cost retailers, right? So lower income consumers have just experienced higher inflation. If you look at the overall spending and we break it out into quintiles, the top 20% of US households consume about 22.5% of these everyday items, right? The bottom is consuming about 17.1%. And you can see how the bottom 20% has basically lost share in overall consumption. Now, let's look just at grocery spend. If we look just at grocery spend, that's not where the inequality is, right? Everyone's buying groceries, and you can basically see that grocery spend, right, indexed to 2022 is equal to 100. There was maybe a little bit more inequality right here in 2023 and 2024, but overall, between low, middle, and high income consumers, there isn't that much inequality in grocery spend. Let's look at gen merch spend. And that's going to include things like apparel, tools and home improvement, toys, electronics, home garden, automotive, sporting equipment, books. This is where the inequality comes in. This is where high-income consumers in blue have basically held steady, right, in terms of the gen merch spend that they're buying. Lower-income consumers are the ones that have cut back from their 2022 levels of gen merch spend, right? So the inequality is coming in from lower income consumers really cutting back on their general merchandise spend. Very quickly, let's chat about tariffs. So if tariffs had been at 20%, this would have been the highest tariff rate that we've had since the 1930s. The effective tariff rate is actually around 17% right now after all these negotiations that happened. When I talk to a lot of our clients, what they tell me is it's not the tariff level that's so problematic. It's the chaotic implementation of tariffs that we've had. So take a look. Since 2010, tariffs barely change. And if they change just a little bit and they change very slowly. And then suddenly we got a lot of tariff changes very quickly in 2025. Let's zoom into those. And you can basically see the tariffs jumping around with this April announcement of tariffs, and then the pauses that we got into place, and then more pauses, and then more tariffs being put in. And so the issue that a lot of manufacturers, a lot of importers are facing is just that tariff implementation has been very chaotic. Now, what is the actual tariff rate that companies are paying today? It's around 12% as of August 2025, and it didn't really change that much going into September. And this is basically taking the amount of tariffs collected divided by the value of all the imports that are coming in. Now, I just said, wait a minute, the effective tariff rate is around 17%. Why are we only collecting around 12%, tariff rate? And the reason is that companies can be pretty innovative, and they can do something called tariff engineering by shifting where it is that they're sourcing their products, or by changing the composition of their products. Let me just tell you a really funny story. Going back to 2019, the US implemented tariffs on European wines, but the tariffs only applied to wines with less than a 14% ABV, alcohol by volume. There were no tariffs on alcohol that was greater than 14% ABV. So not surprisingly, we suddenly imported less alcohol that had less than 14% ABV, and we started importing more alcohol that had more than 14% ABV. We eventually got rid of these tariffs, but I want to show you, let's zoom in for a moment, some of the very creative things that companies can do, right? So there used to be this wine, Renaissance, right? And they had a 13% ABV. Now, if you're tariffed, if your wine has less than 14% ABV, what can you do? Well, you can just make your alcohol hit a little bit harder. And so suddenly the alcohol content was 14.5% ABV. And then when tariffs got removed, the alcohol volume came down again. Right? So if you were drinking in 2019 and you're like, man, this glass of wine is hitting a little bit harder, you're probably onto something, which is there was a higher alcohol content because of the tariffs that were put in place. Right? This is actually pretty distortionary, but companies can find a way to get around tariffs, and sometimes that means changing the composition of their products. We have collected so far $260 billion worth of tariffs this year. This time last year, we had collected about $90 billion worth of tariffs. So that's roughly, $170 billion more that US companies, US consumers are going to be paying in tariffs. How do we know it's US companies and US consumers and not foreign countries that are paying for the tariffs? Well, we know what the price of products are before tariffs are implemented, because the way that tariffs are charged is you present a tariff invoice, or you present an invoice that says, I imported $100 worth of goods, and the US government says, well, here's a 20% tariff on it, but you know the price before tariffs are ever implemented. And those prices, the pre-tariff prices, have not come down, right? It's fundamentally US companies, US consumers who are paying the tariff. Numerator has partnered with the Fed Reserve Board, and we put together this measure of inflation using Numerator data. This is the one that I broke out by low, middle, and high income consumers. You can see that Numerator data matches, Numerator data in blue matches the PCE, the Personal Consumption Expenditure Index pretty well. We then took Numerator data. We used something called the Global Trade Identification Number in Numerator data to match where products were coming in from. And we are able to see with that for products coming in from China, their prices today, as well as of September, are about 8% higher than they were a year ago. This is where the tariff impact is coming in, right? For products from Mexico, they're about 3% more expensive than they were a year ago, versus products made in the USA are about 1.8% more expensive than they were a year ago, right? A lot of inflation right now is really being driven by core goods in the consumer basket, and that's because a lot of these are imported. This is where we see higher inflation. If you look at core inflation overall, it's held sticky right around 3%, but it's being pushed up because of this inflation related to tariffs. Now, this puts the Fed Reserve in a little bit of a bind because they're having tariff pressure, but they're also having a slower labor market. And so this is why they've reduced interest rates more recently. Yesterday, they brought interest rates down. We are at this 3.5 to 3.75 range at the moment. My expectation is that the Fed is now going to hold steady to get more information on where the labor market or where inflation settles. When we ask consumers, what is more important to you, rising prices, inflation, or higher unemployment, both equally? Like, what matters most to you? Most consumers are still saying they're mostly concerned about rising prices, inflation, but you see that both equally or higher unemployment has started gaining importance over time, right? So the Fed is right, if you're thinking about what consumers are concerned about, to be shifting its focus away from inflation towards its other side of its dual mandate, given that this is, we're seeing softness in the labor market, and this is something that consumers are becoming increasingly more concerned about. Lastly, in the last couple minutes that I have, let's talk about consumer sentiment versus consumer behavior. So when we ask consumers, what one word would you use to describe the United States today? Most consumers say struggling, divided, chaotic. We get a few betters and we get a few greats, improvings, but mostly consumers are saying, look, the US economy, the US is struggling, divided, bad, terrible, sad, expensive, a mess, right? This is a pretty pessimistic sentiment. We finally found something that unites consumers both on the left and the right. So we know where consumers live based on their zip codes. Based on that, we know what was the vote share for Harris or Trump in the 2024 election. We can then look at what consumers on the right and left are saying, and we get struggling and divided and struggling and divided. And so we finally found something that, unites the country, which is we're collectively concerned about the state of the US economy. Now, when we ask a different question, which is what one word would you use to describe how you and your household are feeling overall these days, we start getting something a little bit different. We still get struggling, but you'll see that we get a lot more goods, okays, surviving, fine, great, comfortable, right? People are more optimistic about their own situation than they are about the US. And I think this is what is helping hold spending up, is that even if consumers are saying, yeah, I'm concerned about the United States, they're also saying, but for the most part, I'm doing okay. If you look at this by those earning less than 60,000 versus those earning more than 60,000 a year, this is where you get a big difference in people saying, I'm doing okay or I'm doing fine. You're starting to see a little bit of an increase with people saying they're struggling, but not all that different than what we were seeing, back in 2024. When consumers are talking about their own household, things are still holding steady. If you ask consumers looking ahead, how do you think we will be? We've seen this improvement from where we were during the tariff announcements. And we're basically, a little bit worse off than where we were back in 2024. Let me just close in terms of what consumers are most concerned about still, right? Consumers still are mostly concerned about rising prices and inflation. This is their biggest concern. The second biggest concern is political instability, right? We do see some pockets of badness in consumer spending. And so let me give you this example about Hispanic, Latino versus white Caucasian households. Overall in the US, things have tended to track each other pretty closely. But while we had immigration raids, for example, in Chicago, we did see a really big pullback in Hispanic consumption. If we have a big expansion of immigration raids throughout the country in 2026, there's budget for that in the big beautiful bill, then we might again see pockets of weakness amongst certain consumers that are targeted by these raids. When we ask consumers, what will you cut back on? Most of it's things that are more discretionary, like dining and takeout, clothing, accessories, travel, vacations. It tends not to be things like groceries, right? Like necessities. And so in my last couple of slides, let me just mention that things like groceries are incredibly resilient, right? This is food and beverage purchases for off-premise consumption. Every one of these gray bars is a recession. I'm going to put this in year-over-year percent changes. And you basically see that it's very rare for consumers to truly cut back on grocery spend. Look at what happens to household appliances. This is where consumers really cut back, right, during recessions. Every time there's a recession, consumers really cut back on things like discretionary purchases. And then finally, let me put something like air travel, right? Super discretionary. This was the very first thing that consumers said, travel, vacations, in the top three that consumers say they cut back on if they have to cut back. We see things like air travel, household appliances, right? Big discretionary purchases being the things that consumers really cut back. So for CPGs, for retailers, for the most part, consumer spending tends to be pretty resilient, even when times get rough. And so with that, let me pass it back to Ben and to Jack, and I'll stop sharing my slides.
Thank you, Leo, for your insights. I can see we have a couple questions that came in to the Q&A. We'll get to those at the end. But Jack, be mindful of time. I know you've been explaining how this plays out across different consumer groups, specifically lower income and young households. What do you see as the biggest pressure points, and how is that shaping your view for the next year?
Yeah, so I think the biggest pressure point is really going to be what's going to continue happening to the labor market, right? And so far, unemployment has edged up just a little bit. It's still at a good rate, but if it starts edging up a lot higher, consumers are going to start getting nervous and they're going to start, increasing their precautionary savings because they want to have, a cushion in case things get particularly dire. And that can be a snowballing effect, which is if people start cutting back, right, that leads to less consumer spending, then companies start cutting back and they're hiring, and then that's going to just create this snowball. This can become particularly problematic, depending on what happens with the Fed Reserve going forward, right? And so, the Fed Reserve is a really powerful institution. If it becomes politicized, I'm worried about the kind of policies that it might implement and its ability to manage risk both on the inflation side and on the employment side.
Thank you. And I'll get to the last couple questions at the end. But Jack, I know you've also been investigating how it's playing across these two groups we just mentioned. So I think this would be a good segue into your section.
Awesome. Thanks, Ben, and thanks, Leo. Good morning, everyone. As stated, I'm Jack Conley, global economist at Kraft Heinz. And It's always a pleasure to partner with Leo and the Numerator team, and of course, our partners at Macrobond who play a pivotal role in helping us disseminate global macro data and analysis throughout Kraft Heinz. So really appreciate the opportunity to be with everyone today. And no one ever wants to be the guy that has to follow Leo, but that's how the cards were dealt. So I thought it would be fun to build on Leo's presentation and really dissect the legs of the K-shaped economy. So first, I'll talk about the upper income consumers who remain incredibly resilient. Then we'll move on to the lower income consumers who are under increasing strain. And then I'll conclude with an outlook for 26 before we open it up for questions. And so to understand what's behind the strength of the upper income households, I thought it'd be good to start with the stock market. And what we're looking at here is the total return of the S&P 500. And this starts out in 2020. And as the chart shows, a $100 investment in 2020 is now worth $232 today, with technology and AI related stocks leading the way. And of course, this hasn't been a straight line up. We had the COVID recession. We had the introduction of DeepSeek. We had President Trump sweeping Liberation Day tariffs. But today stocks are trading at record levels, and that's due to easing trade tensions, right? Leo talked about interest rate cuts from the Fed, and then we've got a lot of AI optimism. And then the next thing I wanted to explore and think it's important to understand is that when we look at who owns the majority of the assets, we can see that the top 20% of households own a significant majority of the assets in this country. They own about 70% of the assets, and they own almost 90% of all equities in the country, right? And so when we look at this chart on the left-hand side, we can see that total assets by income percentile on the left. In the middle, we have real estate, and on the right, we have equities. And like I said before, the top 20% own a significant more of the equities than the bottom 80%. And so we just acknowledged that we've seen significant stock market appreciation. We've experienced significant home price appreciation. And this has resulted in net worth increasing by about $60 trillion since the fourth quarter of 2019, just before COVID, right? And when we look at what's really driving that $60 trillion, we can see that equity appreciation is responsible for about 40% of that increase, right? But as this chart shows, we can see that the significant majority of the increase in net worth has accrued to the top 20%, with the top 20% having their net worth rise by almost $40 trillion compared to only $2 trillion gain for the bottom 20%, right? And so this divergence is really fueling and shaping the K-shaped nature of the economy that Leo was talking about. And so not only do we have record stock and home prices, right? But we also know that many high-income households own their homes and were able to obtain or refinance their mortgage at record low rates exiting the COVID pandemic, right? And this turned out to be an incredible hedge against inflation and the subsequent, historic rise in mortgage rates, right? And so on the left hand, we can see that, those in the bottom 60%, right, are much more likely to rent, right? And so that's those green bars on the left. And so this has left these households vulnerable to large rent increases that we experienced during the COVID pandemic, while the top 20% were effectively hedged against this rise in rent inflation because they had locked in these low mortgage rates. And as Leo, showed in the previous section, right, this is all translating into record high consumer spending being driven by the top 20%. And so, as most in this audience know, consumer spending, right, is the lifeblood of the U.S. economy, accounts for about 70% of GDP. And when we look at this analysis from Moody's, we can see that the top 20% are driving a significant share in consumer spending, while the bottom 80% their spending is just barely keeping pace with inflation, right? And so again, this is going back to the K-shaped nature of the economy that's really being fueled by the increase in net worth and the wealth effect that we've been discussing. And then, we see this translating out in CPG and food companies, right? Despite all of this net worth, we know that high income households, they're still looking for value, right? And so when we take a look at recent earnings announcements, we know that high income households are driving outsized share growth for Walmart and Dollar General. And, companies like McDonald's note that, while it's not just the low income consumer that's looking for value, all consumers are looking for value, and that's paramount in today's environment. And the way we see this coming to life in food and beverage, right, is that value-seeking behavior is translating to robust dollar sales growth for private label manufacturers, right? And so as this chart shows, we're looking at total food and beverage dollar sales growth for branded players, right? That's the blue bar. Private label is the red bar. And as we can see, private label has been handedly outperforming its branded competitors since 2022. 2022 coincides with the historically high food inflation that we experienced, reaching over 13% in August of 2022, and has remained elevated since. And so this has caused consumers to shift to private label to manage the high cost of groceries and other essential items. And then in the next section, right, I wanted to look at the lower end of the K and see, build on some of the themes that Leo introduced in the first half of the presentation. And so here's some consumer sentiment data from Morning Consult. And what we're looking at here is a high income sentiment, which is the dark blue. We can see middle income sentiment, which is the purple. And we can see the low income sentiment, which is the royal blue. And what we're seeing here is that the gap between the high income and the low income sentiment has reached historically high levels as low income consumers remain burdened by the high cost of living. And most recently, the government shutdown, where over 41 million low income consumers were highly uncertain about whether they would receive critical food assistance, known as SNAP benefits. And then interestingly, we can see that as soon as the government reopened and that these consumers were paid their benefits, we can see an uptick in inflation, or excuse me, in the sentiment, right? But it does remain at historically low levels. And the other thing I think is worth pointing out is that the levels of consumer sentiment today for the low income consumer is about where it was during the depths of the COVID pandemic. So I think that really speaks to the way that these consumers are feeling glum about the economy and their future prospects. And then a big reason for that, right, is that the low income households spend disproportionately on essential items like food, housing, and healthcare, right? And so if we look at the consumer expenditure survey, we can see that by income quintile, that the lowest 40% of consumers spend an outsized portion of their annual spend on things like housing, transportation, food, and healthcare, compared to, say the highest 20% who only spend 64% on these items versus about 80% for the bottom. And what this really means is that, as Leo's inflation index showed earlier, is that inflation has hit these households harder than most because of the significant price appreciation or inflation that we've experienced in these items. So what we're looking at here is cumulative price growth since January 2020 for key items like electricity, used cars and trucks, fuels, housing, food, right? And so we can see that many of these items have increased over 30% when, and then when we compare that to, say, the average hourly earnings or the earnings growth during that time, we can see that, the items highlighted in red have experienced significant price growth that has outpaced earnings growth, right? And this has made these items relatively more expensive or less affordable, right? And so this is really weighing on consumer sentiment for the lowest 40% of consumers. And when we look at survey data from the University of Michigan, we can see that low and middle income consumers overwhelmingly blame higher prices for their worsening financial conditions, right? So in October of this year, 46% of all respondents stated that they were worse off financially than they were a year ago. And when they cited the reasons, they overwhelmingly are blaming higher prices and lower incomes for the deterioration in their financial situation. And then, this is also translated into higher inflation expectations, right? And so we can see that the lowest third of consumers, their inflation expectations over the next year are much higher than their middle and upper income counterparts, right? And this is in large part due to tariffs. We can see the big spike in 2025, mostly attributable to tariffs. And then the other thing worth mentioning, right, is this theme of affordability is really taking shape throughout the country, and most recently is playing a major role in recent elections in New York, New Jersey, and Virginia, as high inflation is really weighing on sentiment and the future outlook for money in the country. And then finally, just wanted to talk about how we're seeing this K-shaped nature of the economy formulate in the labor market, take shape in the labor market, right? And so what we're looking at here is wage growth by the top 25% of earners and the lowest 25% of earners. And so what we're seeing here is we know that exiting COVID, the lowest earners saw the largest wage hikes coming out of COVID due to a tight labor market with high demand for essential workers, right? And so this resulted in outsized wage gains for the lowest 25% of earners. But starting in October of last year, those post-pandemic trends have essentially reversed, where now the highest 25% of earners are their wage growth is growing significantly more than their lowest 25% counterparts. And then, the last thing I wanted to talk about the labor market was, this slowdown that Leo had mentioned and the cooling of the labor market. We see this disproportionately impacting those earning less than 50K, right? So what we're looking at here is Morning Consult's pay loss rate, which provides a weekly measure of U.S. layoffs and hour reductions. Again, we have this broken out by those earning under 50K, 50 to 100K, and then 100 plus. And again, another great example of the K-shaped nature of the economy with, increasing pay loss rates for those earning $50,000, while we see a decrease in the rate for those earning, 50 to 100K, right? And again, just surveying the consumer companies that we track very closely here at Kraft Heinz, we can see that food and beverage companies are feeling the pain of a stretched consumer who's been worn down by years of high inflation. So we've got Mondelez talking about people opting for essentials. We've got McDonald's talking about lower income traffic declining by nearly double digits. They're cautious about the outlook for the consumer and expect pressures to remain into 2026. And then, of course, Coke recently noted that lower income consumers are under pressure, doing value-seeking behavior, looking at different channels, opting for smaller pack sizes, looking for value entry points, right? And so all of these behaviors are manifesting due to the high cost of living and resulting in value-seeking behavior across all income spectrums. And then just before we turn to 2026, right, I did want to, call out that one thing that, we're focused on is the upcoming changes to SNAP, right? And so there will be reductions to the food assistance program known as SNAP benefits started in 2026. And so we do expect headwinds to persist for low-income consumers who still face affordability challenges. And then for about 2.5 million individuals, will soon lose their critical food assistance, which should only further exacerbate those concerns. And then, I know we're a little over, so I thought maybe we just open it up for questions, but a couple of key themes, that we're thinking about next year is that inflation is expected to remain elevated due to tariffs and resilient demand, which will further exacerbate affordability concerns. We do expect high-income consumers to continue driving overall consumption, but this does make us highly leveraged to AI, right? And the risk that a stock market correction could result in a negative wealth effect. We do know many consumers will benefit from the tax benefits of the One Big Beautiful Bill, increased child tax care credit, no tax on tips, no tax on overtime. But we also do know that those SNAP recipients impacted by the One Big Beautiful Bill cuts will be facing hardships. And then I think the labor market should remain in a state of low hire, low fire, with fiscal stimulus and rate cuts acting as a stabilizer to the unemployment rate. But there will be headwinds to job growth from immigration policy, stricter AI implementation, more robust AI implementation throughout the economy, and the uncertainty caused by tariffs. So with that, kick it over to Ben and would love to take any questions.
Thank you, Jack. We're going to stay until the end of the hour, so everyone feel free to add questions into the Q&A. We already have a few, so I'll get started on them right away. I think, Jack, the first one will be for you. How do you see AI-led productivity continuing to fuel softness in the US labor market, potentially easing service inflationary pressures? And what does this mean for how dovish the Fed can turn in 2026?
Yeah, so I think, like we noted yesterday, I think it's unlikely to see, significant layoffs due to AI, but I think we've recently seen that companies like Amazon are saying that they are not going to hire as many workers due to AI adoption in the future rate, right? So I do think that will keep a lid on hiring, but I don't expect it to play a significant role in layoffs or an increase of layoffs, at least this early in the AI cycle. I still think we're pretty early. And then as for the impact on services inflation, I do think we continue to see services disinflation. So as productivity increases, that should, only continue. But again, I still think we're early in the adoption cycle to see any meaningful disinflation from services due to the AI productivity increases.
I'll jump in there as well. When we think about AI, there's a inflationary impulse in the beginning, right? Because you're building out data centers, you're building out energy infrastructure, right? So, the initial impact, and we're seeing it right now in terms of the higher cost of energy services, right, is inflationary until you get the capacity to really have, AI up and running. And then AI can be disinflationary because you get the higher productivity, and you maybe contribute to some weakness in the labor market as companies don't need to hire quite as much. But we do have to keep in mind that this initial build out of AI infrastructure is in itself creating a lot of demand. And Fed Chair Powell mentioned this yesterday, that a lot of business investment right now is related to AI. And so that's keeping inflation a little bit higher than it would be otherwise.
Thank you both for that. The second one will be for you, Leo, asking about if there's additional signals of the disparity in things like eating out, travel, and home improvement.
Yeah, that's exactly where all the disparity is coming in, right? It's in the travel, it's in the eating out, it's in the appliance purchases, right? It's in all the discretionary sectors where we really see that inequality, right? The example that I always give is that I'm sure Jeff Bezos and I both use the same toothpaste, right? There's only so premium that you could go in buying toothpaste. And yet his house is much nicer than my house, right? And that's where the inequality comes in, right? It's the big ticket purchases, some of the service expenditures, but it's not the everyday purchases. Even when we think about, like, let's say you're driving, across, from Chicago to Detroit, you're only going to be able to eat at certain type of restaurants while you're on the road. Regardless of how wealthy you are, your availability is going to be limited to, McDonald's or Taco Bell or Wendy's, which is what it is that you get, on the side of the road in between. And so you really have to think about, like, for a lot of the activities that we do, we're kind of constrained to being a lot more equal for these everyday type of purchases. The inequality really is in that everything else, the discretionary stuff. One of the things that we see is that when consumers say they aren't doing well, they basically don't increase their holiday spending, right? They're not buying that much more on Christmas than they tend to buy, every other month of the year. While those households that say that they are doing really well are the ones that really increase their holiday spending. And what this suggests to me is that, the difference between doing well and not doing well is, can you do more than just buy the everyday basics? But the everyday basics tends to remain pretty constant, even for households that say they're not doing great.
Thank you, Leo. And we have a couple more minutes here. We have a question, someone in the chat saying, what worries me is to purchase good, which I believe is at an all-time high with 25% of US consumers purchasing groceries with buy now, pay later. Any thoughts on how this feeds into US consumer spending overall, and is it a causal relationship with inflation?
Jack, you want
This
to
for
take?
either of you. Feel free to take it.
Maybe let me start with the high aggregate level, which is at an aggregate level, consumer debt to income isn't bad, right? But again, this is an average. Once you start decomposing the average, you do see that lower income consumers are starting to leverage up again. The thing is that even lower income consumers, they're in a worse spot than they were in 2022, but they're not all that different than when they were in 2016, 2017, 2018. And so we're getting back to the levels that we had pre-pandemic, even though we are much worse than we were in 2022 when consumers, even lower income consumers, were doing so much better overall. In terms of using things like buy now, pay later, right? That's consumers were previously using payday loans, right? It's just that payday loans were harder to track versus buy now, pay later. And so it's not necessarily a shift into a really big concerning change in how consumers are paying for things. It's just that technology has allowed them to use, buy now, pay later versus, payday loans that you used to get at a, cash checking place previously. So yes, it's concerning. It's just not differently concerning than it was, in 2016, 2017, 2018.
With that being said, we only have a minute left, so I'd just like to thank everyone for attending today's seminar, and an enormous thank you to you, Leo and Jack, for all the time and effort you put and your insights as well. Thank you very much.
Thanks,
Thank you,
guys.
everyone.